Well, President Joe Biden is expected to return from the Middle East with an agreement on energy output, which could relieve some pressure on gas prices. Let's discuss all of that with Dan Hynes, who's the senior commodities strategist at ANZ. Well, that's a hope anyway, and that's certainly the sort of political narrative that the president is hinging on going into midterms. But how likely is more output from the Middle East going to translate to lower prices at the pump? And to be honest, the president obviously also made the point that we have seen gasoline prices come down.
Yeah, look, I think it's a tough ask. The OPEC and the broader sort of alliance obviously concerned about the pickup in demand they're seeing, and that was shown in OPEC's monthly report this week that they see increasing demand for their oil, and so dipping further into that limited spare capacity that they have at the moment just exposes them, to potentially, further issues down the track, the inability really to react to any further disruptions. And we haven't actually seen the full effect of sanctions on Russian oil to date. So I think it's certainly going to be a tough ask, but as I said, it's the narrative that we're seeing at the moment, and I do suspect they're more concerned about reducing consumers' expectations of rising gasoline prices, which is in part already played out with that fall that we've seen over the past couple of weeks.
How concerned are you about the demand destruction story? Because there is this revival of potentially COVID-0 continuing to be enforced in China, potentially more lockdowns weighing on that demand side of the story.
Yeah, it's a concern in China. I think we've seen it in other regions where this stop-start sort of application of restrictions has really caused a lot of caution amongst travellers. And if you're in China now, you would certainly be debating whether to travel between cities in case you got caught up in that. So, I think the Chinese outlook is rather mixed at the moment. But ultimately, I think the market needs demand destruction. The level of supply disruptions we're expecting over the next 6 to 12 months are quite significant. I think this is what markets do: push prices higher to get either supply or demand to react. Now, supply can't at the moment, so we need to see demand ultimately lower to rebalance the market.
Even in the metals market, how much pressure are we seeing on the supply side of things, especially given this focus on environmental policies, not to mention just trying to raise output in places like Australia or Brazil?
Yeah, I think it's lost certainly at the moment where all the focus has been on the Russian-Ukraine war and that impact on output and exports and trade. The ongoing sort of suppression of investment as a result of a variety of factors, as you pointed out, ESG issues, but also just the difficulty in mining in countries like South America or continents like South America. It's becoming quite significant. So it's an issue, I think, over the medium term, which will continue to play out, I think, in terms of pricing.
What about the broader global macroeconomic dynamics? A stronger dollar, or say just rate hikes being played into, say, precious metals as well?
Yeah, well, I mean, investors are certainly sort of in a risk-off tone, and the higher inflation rate last night does keep that pressure on. And I think, for the moment, all the focus is on that potential economic slowdown in developed markets. But I am hopeful that we'll start to see some of that offset by China. The strong growth in copper imports for June does raise some hope that we're starting to see consumers gain some confidence that they can restock, and that may partially offset the weakness in developed markets. But I think for the moment, there's probably still more downside to come, considering the bearish mood of investors.